In the last video, I talked to you guys about how I was looking at H&R Block and I saw that it had an equity yield of 11.4% based on the current share price. But I also said that I could increase that equity yield based on an option strategy. And it's actually something that I did do when the stock dipped, and I got an investment yield of at least 20%, or actually at least 15%. But it's very likely that it'll be around 26% or so. And so that's what I want to dive into with you guys. And so as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, these videos on H&R Block are generally not the more popular videos, but I love it because this is the one that I'll use to provide the more hardcore audience of my channel with some really useful advice. So I'm going to talk to you guys how I believe that I will earn 26% on H&R Block. So now, first, let's start with risk, because the risk that entails with this is predictability. Now, the other thing that I will say is just a straight up disclosure. I do not recommend you guys to buy any security that's mentioned on this channel. Always do your own due diligence and consult an investment advisor to even see if stocks are right for you. Now, I'm not even saying that just from a legal perspective. I'm saying that because I genuinely care about the people that tune into this channel. So let's get into the risk side first. So the first thing that you got to be aware of is, H&R Block says, and I'll show you in the chart there afterwards, that they're going to grow revenue at around 3 to 6%. And so the first thing that I'd look at is, what do the last 10 years look like? Well, you can see over the last 10 years, they have a revenue CAGR of 1.8%, which largely reflects the major segment of the company, which is the US tax preparation. So they have not been able to grow their revenue at the rate at which they expect to grow revenue in the future. And for 2023, they are also not going to hit the 3 to 6% top line revenue growth. So one of the things that you have to take into account is, if you're modeling revenue growth at the long-term rate, which I am, basically starting in 2024, you might be kidding yourself. And so I'm actually looking at this and thinking maybe I should tone down my growth forecast and maybe go like closer to the lower end, maybe at 3% for next year, and then just bring it up slowly to 4.5%. So I might do that at the conclusion of this video. Now, the other thing is, notice that they're I look at this company as a dividend paying company, not just the dividend that they pay quarterly, but 100% of free cash flow. So that's kind of the way I look at it. And so because I look at this as a dividend paying company, I'm looking for like a dividend hurdle rate of around 15% or close to. So if I'm going to buy the stock, I'm looking for an equity yield of 15%. Otherwise, I don't want to get into it. Maybe I'll do it for 14, or maybe anything close to around 14 I might do it, but I'm really looking for that 15%. So that's kind of the way I'm looking at it. This is an income type investment for me. Now, you get the income in two different ways. You get one with share repurchases and the other with the actual dividend. And just looking at H&R Block's P&L, you can see that the way I'm forecasting it out is I'm using guidance for 2023, and then for 2024 I'm just doing the midpoint of their long-term guidance, because here's where I think I should probably do this at like maybe 2%, and then go up to maybe 3, and then 4.5 like thereafter. And so that'll probably reduce the valuation. It might be selling at 65% of its intrinsic value as opposed to 60%. So you'll see something like that when you jump into the model. But ultimately, $3.72 versus $4, like it really just is, in my opinion, just ultimately like a $4 stock. Some years you're under it, and the early years you're under it, the later years you're over it, but ultimately it's just a $4 stock that grows at the rate of inflation, or that's what I expect. And so really it's an 11.4% equity yielding company, and you'll see that in the valuation as well, because I put the same calculation right there. But you can see I'm valuing it around $53 per share. Maybe when I change that valuation, it might go to like $50 per share, but ultimately you'll be somewhere in the 60% of its intrinsic value. So it's still not expensive using a 15 times terminal multiple. Maybe you want to use a lower multiple. I don't know. It's up to you. But really the bigger question is, how can I increase this equity yield? Well, I can use options. And so the strategy that I want to follow is called the at the money covered call option strategy. So really what that does is I buy the stock and I simultaneously sell a covered call. I give up upside on the security. And really, I don't really care about the upside, because remember, I'm looking at this as a dividend type of security. Now, look, you should always be looking at all securities that you buy as equity yielders, but specifically these types of ones where you're really looking to, when you buy value, you're buying value at the purchase price. Now, if I want a 15% equity yield, what you got to do is you got to take the $4 per share that you expect over the long term and divide it by 15%. And so when you take $4 and you divide it by 15%, you get to a price of 26.67 per share. So that's really what I'm looking for. Now, the current share price is $32 per share. So I'm not going to get that by just buying the stock outright in the securities markets right now. It's selling at $32. But what I can do is I can use a at the money covered call strategy to own the stock at a net purchase price at or lower that 26.67. And so let's see what options are available to us at the moment. So you can see based on the current at the money covered call, so it's $32.60 and the closest strike price is $32. This is a year out. I always go around a year out and the reason why is you get a higher premium, and so you can bring down the cost basis as much as possible, but ultimately you get a lower yield just because decay is more heavily focused on shorter term options. So there's a trade-off there, but you can see that at $3.50, if you take the current share price of $32.60 and you subtract $3.50 from it, you have a net purchase price of $29.10. That is above the 26.67. So you can see already that this isn't a stock that I'll buy, because 29.1, if you take $4 and you divide it by 29.1, which I'm doing right now, you get an equity yield of 13.7%. Now, you don't need to memorize all that math. What you can do is you can go into the options calculator, put in the inputs, and the math is done for you. Now, the options calculator is available for free in the description of the video. It's available in the description of every video, and so let's get into it right now. Now, I beefed up this options calculator, and I will release it to the public after this video, but essentially, you put in the inputs in the blue cells and everything else self-calculates for you. So if you put in the ticker and the symbol, you'll get H&R Block pulled up with the share price, and then you just put in the exercise price or exercise date for the option that we're looking at, and then you put in the strike price, which was 32, and you get the premium. The first thing you should notice is that if you buy the stock for $32, but you agree to sell it for, if you buy the stock for $32.60 and you agree to sell it for $32, you're going to lose 60 cents on this transaction. And so that's right here. It auto calculates. So you get a negative capital gain. But the other thing is, if you're holding the stock for a year, you're going to generate some dividends. Also, you immediately get this premium. So really what you're doing is you're earning $4.06 on day one. Not on day one, you're throughout the term of the investment, because you make the capital gain loss and the expected, you make the capital gain loss at the end, and you get the expected dividends throughout. So let's just assume that you earn this all throughout. It just makes the math easier. And so really what you're doing is you're generating an equity yield, a yield of $12.56, and that is if you do not, that is if you get exercised on this option. So you sold $32 at the end of the term, it's trading for, you bought it at $32.60, and at the end of the term, because you agreed to sell it for $32, the shares are currently trading above $32. So you no longer have the shares. All you are left with is this. And so what this is if you just take $4.06 and you divide it by the $32.60, which is what you paid, and I'll just do it quickly here, you get 12.45, which is pretty much this calculation here. And really what it's doing is it's showing a little bit higher of a percentage, 12.56 versus 12.45, because you have just slightly lower than 365 days. So that's all that is. And so yes, this is better than the 11.4%, but it's not my cup of tea, because for two reasons. One, it's not giving me an annualized yield above a hurdle rate of 15%, which is what I look for. But the other thing is, take a look at this. Your equity yield is 13.7%. And that's what I mentioned previously when we were originally looking at the options on the other slide, where I did say that you buy the stock at $32.60. Right? Let's just go through the math here. And then you get a total return, you get a covered call premium of $3.50. So $32.60 minus the $3.50. So your net purchase price on day one is $29.10. In fact, this is what I would enter into the brokerage account if I was looking to buy this stock. I would do a simultaneous stock buy and covered call sale, and you can actually enter that in with your brokerages. They allow you to do that, so you just give them a net price, and so the net price that I would give is $29.10. But really, that $29.10, once again, that $4 divided by the 29.10 reflects 13.7%. So here's the thing: if I'm not exercised on the security, then what I've done is really I'm essentially generating the equity yield of the company into perpetuity because in the first year you get the premium, but thereafter you're only generating the equity yield. You're not getting a premium every year, so you're really getting $4 divided by 29.10 every year, because the premium goes down and brings down your cost basis, because remember, you bought the stock for $32.60, but you immediately received $3.50. So really what you did is you paid a net of $29.10 for the stock. And so is this equity yield reasonable? I don't know. For some people, 13.7 might be good. For me, it's not. I want this to be higher than 50%. Now, here's something interesting if you want to think about it. In your first year, if you don't get exercised on the security and thus you're holding onto the stocks, look, I don't know how to spell exercise, but anyways, if you don't get exercised and you, instead of making this 12.56 in your first year, you actually get a bit of a windfall. So here's what it is. You earn the $3.70 earnings per share, which is what they're expected to earn over the next 12 months, or that's just what I'm projecting. Plus, you also earn the $3.50 of covered call premium. So you actually earned a yield of 22.2% in your first year. But actually, it's 22.1 because I mistakenly divided by 32. You should actually divide it by the price you paid for the share, which is 32.6. So it's actually 22.1. But that's a very interesting thing because you make a nice return in your first year. However, remember, you're only earning the 3.7, or call it 4 thereafter. And so it's really just 4 divided by your net purchase price, which is the 29.10, which is what this calculates. This is the most important number. This is the thing that I look at. But also, I guess I kind of look at both. But this is more important because this one I know is higher because, if I get exercised on the stock, I do make a higher premium in the first year, but, in holding the stock, it has to make sense to hold it on a net purchase basis. And it just doesn't make sense, which is why I would walk away from this particular option security. However, you guys may recall that because of the IRS situation, the stock actually dropped under $30 per share. And if you had access to the tracker, you would have saw this happen the day that it happened. And the tracker doesn't just track what happens in the day. There's also a section that tracks what happened over the last week, over the last month, and over the last year. I look at all of those sections every day to see what's going on. And so when the stock did dip under $30 per share, it actually opened up some pretty interesting opportunities. And so let's take a look at one opportunity that I saw and I actually transacted on. So the other thing that I do want to point out is that don't copy me here because I'm extremely biased on H&R Block because it is now a part of my portfolio. So once again, do your own due diligence, talk to an investment advisor to see if stocks, options, all that stuff is right for you. So here's something similar to what I was looking at. So it's not exactly what I was looking at, but it's very similar. So the stock dipped under $30 per share, presenting us with an interesting opportunity. So I just colored this green and I typed in $29 into that same model. Of course, the premium went up to $4. And so, the total return is up from $4 because of the higher premium and the potential capital gain element. Because remember, it's the strike price at $30 per share is actually higher than the price that you paid for the stock. And so you actually get a capital gain of $1 if the stock gets taken away. And I do believe that this stock gets taken away. I would love if it didn't, but I do believe it gets taken away. Your premium is $4 and your expected dividends throughout that term are $1.16. So if the stock does get taken away, your total return is $6.16. Remember, the only thing you're left with is money. You're not left with the stock. And so the $6.16 reflects a total annualized yield of $21.42. Now, this is much better than that 12.6% that we saw. It definitely meets my 15% hurdle rate. So this passes on this analysis. Now, the other thing is that, this is just the first part of it. This is worst case scenario because I only get the stock for 1 year. Yeah, I made 21.5% on it, but then I'm provided with all of the capital back and now I have to look to redeploy it. And the problem with that is that as the portfolio gets larger and larger every year, it's harder and harder to deploy capital. Now, I'm still small enough, and I probably will be small enough for the rest of my life where it's not super hard to deploy the capital, but really what makes it hard to deploy the capital is that in any given year, it's very hard to find the right opportunity. So when the opportunities come, it might actually make sense to take the 14% yield and just roll with it, or at least previously we saw that 13.7. It might actually make sense to take the 13.7 as opposed to taking the 16% or waiting for the 16. So there's an argument for that. And I just want to call out my own bias here. But keep in mind that, I did wait for this and it did come. And so call it what it is. Now, here's the thing. If you are not exercised in your first year, notice that what you actually did was you actually made the 12.8% equity yield, the 3.7 divided by the $29 per share that you paid. And because you held the shares for the year, you also earned the $4 covered call premium. So you actually earned a total yield of 27%, the $3.70 plus the $4. So you actually made 27% on this. But, that is only for the first year. Thereafter, you only make, call it $4 divided by the net purchase price of 25. Because remember, the price of the share was $29. The premium was $4. And so the net purchase price is $25. And so 4 divided by 25 gives you an equity yield of 16. So that's what you make thereafter. But once again, that surpasses my 15% equity yield hurdle rate. So no matter what happens with this investment, it makes a lot of sense, especially in that first year, because if you get exercised, you made 21%. If you don't get exercised, well, you made 27%. And every year thereafter, you make 16%. So not a bad investment no matter what happens. And this is what I call using options from the perspective of a value investor can really reduce your risk and increase your returns. And so this is why I went big on this investment. Now, where's the risk? The risk is that this $4 per share EPS rate falls off. The risk is that the company's earnings don't materialize the way that you expect them to. The other risk is that the company uses the $4 per share for a capital investment that doesn't pay off either, so they destroy shareholder value. The other risk could be that the shares run up considerably and management is still buying back shares at a much more expensive price, and so that is a situation that you can run into as well. So it's not all rainbows. Every investment has a risk, and those are some of the risks here. Now, also, I want you guys in the comments to let me know what other risks I've missed, but also what is wrong with this type of strategy. Let me know what you guys think. But it is something that I did dive into, and maybe a year's time from now, if the stock dips even further, I might do a little bit more, but we'll see how it plays out. Now, I'll leave it there for you guys, but if you missed the last video where I talked about how I don't think H&R Block is going to get impacted materially by the IRS's new move into making returns free to upload, you can get access to that video right here.